Hey everyone, and welcome back for another deep dive. This time, we're looking at Jim Cramer.
Jim Cramer?
You know,
Yeah.
the Mad Money guy.
Yeah.
We're going to go beyond just like the TV persona and actually look at, his stock picks, his recommendations over the years.
Right.
We've got a bunch of articles here going back, decades,
Yeah.
and looking at some of his big wins,
Yeah.
his not so great calls,
Yeah.
and everything in between.
For sure.
And I think the data might surprise you a little bit.
Yeah.
For example, did you know that historically you might have actually done better betting against some of his buy recommendations?
It's true.
Oh, wow.
Yeah. And that's something we'll certainly explore in detail.
Okay.
It's fascinating because he has this reputation for being so bullish,
Right.
right? This exuberant personality.
Yes.
But when you actually crunch the numbers, the story's a little more nuanced than that.
Okay, so before we get into the numbers, can we back up a bit? I feel like even people who've seen him on TV,
Hmm.
they might not know that much about his background.
Absolutely.
Where'd this guy come from?
Right. So before he was, this financial guru that we know today,
Right.
he actually had a pretty diverse career path.
Oh, really?
Yeah. I mean, he started as a reporter, believe it or not.
Wow.
Even covered the Ted Bundy murders early in his career.
That is wild.
It's a very surprising start for someone who, ultimately became a Wall Street icon.
It's not exactly the typical path.
No, it's not.
Is finance.
It's not the usual resume item.
It makes you think, like, did that experience, covering those really intense, high-stakes situations,
Yeah.
did that set the stage for his later career?
I mean, it's very possible.
Wow.
You can definitely see how that kind of, being drawn to these high pressure environments
Right.
continued as he transitioned into finance.
Right.
1987, he founded his own hedge fund called Cramer and Co.,
Oh.
which actually did very well during its run.
So clearly he knew what he was doing.
He clearly, knows his way around the market.
Yeah.
But as we mentioned, his track record is far from perfect.
Right.
And one of the moments that really stands out, in terms of his, some of his misses,
Mm-hmm.
is his involvement with the tech bubble back in 2000.
Yeah, the dot-com bubble.
Right.
Yeah.
So just weeks before the NASDAQ crashed,
Oh, wow.
he gave the speech at an industry conference where he was very enthusiastically recommending
Uh-huh.
10 tech stocks.
Okay.
Now, looking back,
Yeah.
some of these companies,
Yeah.
their earnings were a little questionable, to say the least.
Okay.
They weren't exactly, the soundest investments.
So was this a case of him just getting swept up in the hype?
It very well could have been.
I mean, everybody was talking about tech stocks back then.
Everyone was.
It felt like, the market could only go up.
Right. And that's a crucial point because the whole tech boom created this atmosphere
Yes.
of almost like irrational exuberance. So he wasn't alone in his optimism.
Right.
But I think this event kind of solidified his image as someone who makes these bold calls.
Oh.
Sometimes they pay off and sometimes they don't.
So even the experts can get caught up
They
in
can.
market trends.
They can, and it happens all the time.
And speaking of big calls that didn't quite go as planned,
yes.
we have to talk about his infamous Bear Stearns is not in trouble statement.
Oh, yeah.
And this was just days before the bank collapsed.
Right.
I mean,
This is one of the most scrutinized
yeah,
moments of his career.
yeah,
And for good reason.
yeah.
I mean, here you have one of the most recognizable financial commentators essentially giving this vote of confidence
Wow.
to an institution that was on the brink of failure.
Yeah.
And, this call wasn't just about being wrong.
Right.
It raises questions about whether, maybe personal relationships or a desire to kind of project this image of stability during a very turbulent time clouded his judgments.
Yeah, it makes you think about the weight that someone like Kramer's words carry.
Absolutely.
Especially in times of uncertainty, people are looking for some kind of guidance.
They're looking for someone to tell them
Yeah.
what's going on.
Yeah, and in this case, that guidance was tragically off the mark.
Sadly.
Yes. There's another call that really stands out,
Okay.
and it kind of speaks to a broader trend that was happening in the auto industry at the time.
Yeah.
And that was his recommendation to buy General Motors stock in 2005.
Right.
This is years before the company filed for bankruptcy in 2009.
Yeah. To understand this call, you kind of have to consider the context of the auto industry at the time.
Okay.
I mean, there were signs, right?
Mhm.
Rising fuel prices, increased competition from foreign manufacturers.
Right.
But, the full extent of the challenges that were ahead,
Yeah.
that ultimately led to GM's bankruptcy.
Right.
They weren't really, apparent to a lot of people.
So was this just a case of kind of missing those crucial warning signs or underestimating how serious the problem was?
I mean, it's hard to say for sure.
Yeah,
Hindsight's always 20/20,
of course.
but it does make you think, could he have dug deeper?
Right.
Could he have, anticipated the potential for such a dramatic downfall?
It's a good reminder for all of us to kind of zoom out,
Yeah,
look at the bigger picture
absolutely.
when we're making investment decisions.
You can't just focus on one company.
Right.
You got to look at the industry trends, the
Yeah.
larger economic forces,
Absolutely.
because those can have a huge impact even on seemingly stable companies.
Okay, I want to talk about a story that I find really fascinating
Okay.
and honestly kind of cautionary.
All right.
It's often called his worst investment,
Oh, yeah?
and it's the Memorex Telex misstep.
The Memorex Telex.
Yeah, and I think, a lot of people can relate to this.
Yeah.
This idea of thinking they've found some hidden gem.
A diamond in the rough.
Yeah.
Right.
So he bought hundreds of thousands of shares
Hundreds of thousands of shares.
in this Silicon Valley startup after it went through bankruptcy,
Wow.
believing he found this low risk opportunity.
Okay.
And the quote that really stands out from this whole episode
Yeah.
is him asking, what's the worst that could happen?
What's the worst that could happen?
It speaks to a level of, overconfidence
Yeah.
that I think many investors, especially those who are new to the game,
For sure.
might fall prey to.
It's easy to get caught up
Yeah.
in the excitement.
Yeah.
Yeah.
But of course, as you can probably guess, it didn't exactly end well.
I was going to say, I don't think it ended well
Yeah.
with that kind of statement.
No. Yeah.
Yeah.
It didn't.
No, so this misstep really highlights the importance of, doing your due diligence,
Yes.
thorough risk assessment.
Absolutely.
Even seasoned investors,
Yeah.
like Cramer,
Right.
can get caught up in the, excitement of a potential opportunity
Right.
and overlook those really crucial warning signs.
It's a lesson we can all learn from.
We can.
No matter how experienced we are, sometimes the worst case scenario can happen.
It can.
So we should be prepared.
Yeah.
What about his recommendations with General Electric? He was pretty vocal about GE, even as the company started to struggle in the late 2010s.
Yeah. He was a big advocate for GE for a long time.
Yeah.
And what makes this case particularly interesting is that, he later admitted that this was one of his biggest mistakes.
Wow.
Especially after GE was forced to cut its dividend,
Okay.
which was a move that he had previously assured investors wouldn't happen.
That's a pretty big admission.
It is.
It makes you wonder what led him to hold on to that belief in GE for so long, even as the company was, clearly heading in the wrong direction.
I think it's probably a combination of factors. He was a longtime supporter of GU.
Right.
So there may have been an element of, emotional attachment. And also, let's not forget that, admitting a mistake,
Yeah.
especially a public one like that,
Right.
can be really tough for anyone.
For sure.
Even someone as, successful and outspoken as Cramer.
Right.
But I think what's important is that he ultimately acknowledged this error and hopefully learned from it.
Yeah. And we can learn from it too.
And we can learn from it.
Absolutely. It's a good reminder that, we all make mistakes,
They all do.
even when it comes to investing.
Investing's hard.
Yeah.
It's not easy to always get it right.
Yeah. The key is to be able to recognize those mistakes,
Yeah.
analyze, why they happened, and then adjust our approach
Right. Make those adjustments.
accordingly. But, for all of these misses, there's this really interesting trend with his sell recommendations.
Oh, yeah.
It turns out historically they've actually outperformed his buy recommendations,
Interesting.
which seems kind of counterintuitive given his reputation for being, so bullish on the market.
Right. So we're talking about some significant differences in performance here.
Yeah.
For example, there's data showing an average return of negative 223%
Wow.
on buy recommendations just 1 month after they were given.
Oof.
So, this is where things get really intriguing
Yeah.
and why we really need to look at his track record with a critical eye.
Right.
Could it be that his bearish calls,
Uh-huh.
the times when he's telling people to sell,
Right.
are actually more insightful
Interesting.
than those, kind of enthusiastic
Yeah.
buy recommendations?
Yeah, it's almost like there's more to him than meets the eye.
It's possible.
Yeah, is there some kind of
Yeah,
hidden layer of skepticism or even contrarian thinking
it could be.
that we don't see on Mad Money?
Yeah, that's a great question, and it's definitely one that we'll dig into
Yeah.
as we continue this deep dive.
Yeah.
Because the fact that this trend exists,
Right.
right, and it's significant enough to track, tells us that there's a lot more to uncover about his approach and what we can learn from it. Both the good and the bad.
Yeah.
And it really raises some important questions about how we should be interpreting, financial advice, even from someone as prominent as Cramer.
Okay, so we've talked about his background, some of his big misses, and now this really unexpected trend with the sell recommendations.
Yeah.
I'm definitely starting to see why this deep dive is so fascinating.
It is, and we're just getting started. There's a lot more to unpack here, so let's take a quick break, and we'll be back to explore this whole concept of inverse Cramer strategies.
Okay.
Which might be one of the most surprising things to come out of all of this analysis.
All right, looking forward to it. Right, we're back and ready to dive into one of the most intriguing aspects of this whole Jim Cramer situation.
Yeah.
The rise of what are called inverse Cramer strategies.
Inverse Cramer.
I have to admit, when I first heard about this, I thought it was a joke.
Right. It does sound a little counterintuitive, doesn't it?
Yeah.
Basically, these are investment strategies where individuals or even entire funds deliberately bet against Cramer's recommendations.
So it's not just like a meme.
No.
People are actually putting their money where their skepticism is.
It's a real thing. And to understand why it's gained traction, we need to look at how these inverse Cramer strategies actually work. They're often powered by algorithms and data analysis.
So it's very systematic.
Very systematic.
Yeah.
So, these algorithms track Cramer's recommendations, analyze historical market data, and then use that information to make investment decisions that go against his picks.
That's actually really interesting. So they've taken this skepticism around his calls and turned it into a
systematic approach.
Yeah, like a systematic investment approach.
Yeah, exactly.
And there are even ETFs built around this idea, right?
That's right. Exchange-traded funds, or ETFs,
yeah,
are essentially baskets of stocks that track a specific index sector, or in this case, an investment strategy.
So you can actually buy an ETF that's designed to profit if Cramer's recommendations to perform.
It's a way for people to kind of express their skepticism towards Cramer in a very concrete way.
It makes you wonder what Cramer thinks about all this.
Right.
Imagine turning on your TV and seeing
an ETF betting against you.
Yeah, an ETF that's basically betting against you.
Yeah, it's a fascinating kind of commentary on the whole dynamic between media personalities, financial advice, and this, evolution of the market.
It shows that investors are becoming more discerning.
For sure.
They're not just accepting recommendations at face value. They're actually,
They're doing their homework.
Yeah, they're using data and technology to form their own opinions.
Right.
So why are these inverse Cramer strategies gaining traction in the first place?
That is the million-dollar question.
Yeah. Is it purely because people doubt his stock-picking abilities, or is there something more to it?
I think it's a combination of factors. Cramer, with his, kind of bombastic personality and his, penchant for making these bold pronouncements, he's always attracted, both ardent fans and very fervent critics.
Right.
But what's really changed in recent years is this rise of data-driven investing.
Right. Everybody's got an algorithm.
Everyone's got an algorithm, exactly. So people are increasingly using algorithms and quantitative analysis to make their investment decisions, and they're applying that same data-driven approach to evaluating financial advice.
So when they see data that suggests that betting against Cramer might be profitable, they're willing to put that theory to the test.
They're willing to test it out.
But there's also the human element here.
Absolutely.
People are drawn to his personality, his energy.
Yeah.
Could it be that some of this skepticism stems from the fact that he's such a showman?
That's possible.
Yeah.
He's very good at what he does.
Right.
He's entertaining, he's engaging, and he knows how to create buzz.
But, as we've been discussing, it's crucial to separate that showmanship from the substance.
Exactly.
When we're evaluating financial advice, whether it's from Cramer or anyone else. We need to really focus on the fundamentals.
The fundamentals.
The data, the research, and the underlying logic.
The logic behind the recommendations.
So how do we do that? How can we as individual investors develop that ability to critically evaluate financial advice?
It really comes down to developing this kind of media literacy, especially when it comes to financial information.
I like that.
Think of it as building your BS detector.
A BS detector?
For financial advice.
Yeah. How do we build one?
So, first, always consider the source.
Okay.
Who is giving this advice?
Right.
What are their credentials? What are their potential biases?
Oh.
Second,
Yeah.
don't just take anything at face value.
Right.
Always do your own research.
Do your homework.
Dig deeper. Understand the reasons behind those recommendations and look for supporting evidence.
Okay.
And third, seek out diverse perspectives.
Okay.
Don't rely on just one source for information,
Right.
even if it's someone you trust.
Yeah.
Read different articles, listen to different podcasts.
Yeah.
Get a well-rounded view of the situation.
It's like we talked about earlier.
Right.
Diversify your portfolio, but also diversify your sources of information.
Exactly.
It's all about mitigating risk.
It is. It's not just about risk mitigation.
Right.
It's also about, expanding your understanding of the market.
Right.
And making more informed decisions.
The more perspectives we gather,
Yeah.
the better equipped we are
The better.
to navigate,
The complexities.
the complexities of the financial world.
It is.
So we've talked about the rise of these inverse Cramer strategies, the role of data and algorithms, and the importance of developing that media literacy. But let's bring it back to Cramer himself.
Okay.
We've talked about some of his misses.
Yeah.
But has he had any big wins?
He has.
Has he ever gotten it right?
Oh, absolutely.
Okay.
It wouldn't be fair to paint him as someone who's always wrong.
Right.
In fact, he's had his share of successful calls.
Okay.
One notable example is his early and consistent advocacy for Apple stock.
Oh, that's a good one.
Yeah.
Apple's been, phenomenal performer for years.
Years.
What was it about Apple that he saw early on that maybe others missed?
So Cramer was an early believer in the power of Apple's brand,
Okay.
their innovative products and their very loyal customer base. He recognized that the company had the potential to disrupt multiple industries, from music with the iPod to mobile phones with the iPhone.
Yeah.
He saw that long-term value proposition that Apple offered.
And he consistently encouraged investors to, buy and hold the stock.
So in this case, his bullish enthusiasm was actually justified.
It was.
It goes to show that, even though he's known for these bold calls,
Right.
sometimes those calls are backed by, solid analysis and a deep understanding of the market.
Exactly. And it's important to remember that, investing is not a game of perfect predictions.
Right.
Even the most successful investors make mistakes.
They do.
The key is to learn from those mistakes.
Right.
Adapt your approach.
Yeah.
And continuously strive to make, more informed decisions.
All right. So let's shift gears a bit. We've covered a lot of ground so far.
We have.
Kramer's background, his hits, his misses, the inverse Cramer phenomenon, and even some of his, successful calls, like with Apple.
Right.
It's clear that there's a lot more to him than just the guy shouting, buy, 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 buy on TV.
A lot more.
And I think what makes him such a compelling figure to study
is that he kind of embodies the complexities of the financial world.
He does.
He's part showman, part analyst, part provocateur.
Right.
And his track record, with all of its ups and downs, really reflects those inherent uncertainties and the challenges of investing.
Absolutely.
And it makes me think that maybe the real lesson here isn't about whether to follow Cramer's advice or bet against him.
Right.
But rather how we approach, financial information in general.
I think you're hitting on a really important point here.
Yeah.
Because we live in a world that is just saturated with financial advice. Everywhere you look,
It's just overwhelming.
TV personalities, social media influencers, algorithms spitting out stock picks.
Yeah, it's information overload.
It really is.
So I think as we move into the final part of our deep dive, it's worth reflecting on what we've learned so far. And how we can apply these insights to our own investment journeys. Because at the end of the day, we're all trying to navigate this really complex world.
Yes, we are.
And make the best decisions for ourselves and our financial futures.
Absolutely. And that's exactly what we'll explore in our final segment. We'll delve into the broader implications of Cramer's influence on the financial landscape and what it all means for you, the investor.
We spent this deep dive really exploring Jim Cramer, like his background, his wins, his losses, even the people who are betting against him.
Right.
It feels like we've gone way beyond just like, is Cramer right or wrong?
Yeah, I think what's really emerged is this much broader conversation about how we as individual investors should be approaching financial advice, in this era of just constant information overload.
Yeah, because it's not just him, right? We're bombarded with like financial opinion.
Everywhere you look.
Yeah, everywhere we look.
It's overwhelming.
So thinking about his career, like, what are some key takeaways for us as we navigate all this noise?
I think one of the most important lessons is to remember that no single source has all the answers.
Right.
Even someone as prominent as Cramer, with his, years of experience, he's made some pretty significant misjudgments.
Right.
And this really highlights the need for us to diversify our sources of information.
Right.
And not rely on any one person or platform as our sole guide.
It's like we were talking about earlier, diversify your portfolio, but also diversify your sources of information.
Exactly.
It's all about managing risk.
It is. And that leads to another really crucial takeaway.
Okay.
The importance of critical thinking.
Yes.
We can't just passively absorb whatever we hear or read.
Right.
We need to engage with that information. Question assumptions, consider different perspectives.
And that can be tough, especially when someone is, as charismatic and as convincing as Cramer.
Right. It's easy to get caught up in the hype and overlook those potential downsides.
So we need to develop those critical thinking skills.
Absolutely.
Learn to separate the showmanship from the substance.
The emotion from the logic.
Right. And that involves asking ourselves, some key questions.
Like, what are the motivations behind this advice? What are the potential risks?
Right.
What are some alternative viewpoints?
So it's almost like we need to become our own financial detectives.
I love that analogy.
Right. Gathering evidence, weighing the different possibilities, and ultimately making decisions based on a thorough investigation.
You got it.
But part of that detective work also involves understanding the broader market context.
For sure.
You mean like, economic trends, industry shifts,
all of that.
Even geopolitical events.
Exactly. All of these factors can have a significant impact on investments.
Right.
And it's crucial to be aware of how they might be influencing the advice that we're receiving.
And sometimes, even with all the research and the critical thinking, things still go wrong.
They do.
I mean, we've seen that with some of Cramer's calls.
Yeah.
How do we learn to be more comfortable with that uncertainty?
That's a great question. And it's something that every investor grapples with.
Yeah.
I think part of it comes down to accepting that investing is not about predicting the future with 100% certainty.
Right.
It's about making informed decisions based on the best available information, understanding the risks involved, and having a plan for how we're going to manage those risks.
And it's also about learning from our mistakes. Right?
Of course.
Because we've seen even those seasoned professionals make them.
They happen.
The key is to analyze those mistakes.
Yeah.
Figure out why they happened and adjust our approach accordingly.
Exactly. Mistakes are inevitable.
Yeah.
But they become valuable learning experiences if we're willing to examine them honestly.
So as we wrap up this deep dive, I'm left with a sense of cautious optimism.
Yeah.
Cramer's story with all of its highs and lows reminds us that this world of finance,
it's a roller coaster.
It is complex and unpredictable.
For sure.
But it also reinforces how important it is to be engaged and informed investors who are, constantly learning and evolving.
Couldn't have said it better myself. And I think the key takeaway here is that we all have the power to be successful investors.
Yeah.
Even if we don't have, years of experience or access to insider information.
Right.
It starts with cultivating that mindset of curiosity, skepticism, and continuous learning.
That's a great note to end on.
Yeah.
So until next time, everybody stay curious and keep those brains buzzing.
Yeah.